All right, so we are live on day 2 of the 5-day commercial real estate challenge. Just want to welcome everybody who is hopping on the challenge for this week and ready to get started. So in regards to yesterday, and also before we start, I want to make sure that you guys have your workbook. So if you guys don't have a workbook, make sure you register on challenge.cursorsom.com, and then you will get a link to the workbook. If you don't find it, just message me, and we're also putting it in the Zoom chat as well, so you guys can download that right away. Also, turn your videos on. I want to be able to see everybody. We want this to be interactive and not just me speaking the whole time, but I want to make sure you guys get some good value and are able to ask some questions. And then as far as the expectations, would love to have you guys fully present to get the most out of this. Make sure your phones are turned off, that you guys are here, you're listening, you're being interactive, and you're being present. As far as the end of the week, I'm going to offer you guys something special starting on day 4 on ways that you can partner and work with me to start investing into commercial real estate. So hopefully that can add some value as well. And as far as what we're going to go through the rest of the week, just to give you guys a little summary. So again, we have the 5-day commercial real estate challenge, and going through the syllabus. Today we're looking at the ideal value add commercial real estate, what that deal looks like, and what type of asset classes to target that are most recession proof. Tomorrow we're going to be taking a look at what are the different ways to fund a deal and what is the best strategy. Day 4 is what are the top 3 exit strategies and which is best for you. And day 5, we're going to take a look at how to partner with me directly on your next deal. And let's find a deal with 6 to 7 figures of profit on it in 2024. So that's a little of what we're going through this week. Would love to make sure you guys hop on every day. It's just 1 hour per day. And I hope I can add a lot of value to your 1 hour that you're joining in on. So just to open it up to the audience, yesterday for the homework, I want to see if you guys had any feedback on that. And the particular question is, what goal do you want to achieve next year, and how will it affect your life? Yesterday we talked about creating your 1-year goal for 2024, creating a strategy that revolves around every 12 weeks. So every 3 months, you take a look at that strategy. Once a quarter, you assess it, you pivot if needed, and there's certain goals to pinpoint for the end of 2024. So, does anybody want to go ahead and share what you guys put in for what goal you want to achieve next year and how it'll affect your life?
Okay, so Chris, I'll share if you don't mind.
Yeah.
Um, for my goals, I have again the retail mindset, and some of my goals are to one, develop an online presence and lead generation system. I want to have at least 12 retail sales under my with residential or commercial sales. I want one sale per month next year in 2024. I also want to establish partnerships with builders and with skilled professionals to help me manage at least 3 of my own personal flips, whether if it's a residential flip or a commercial flip. So my goals are looking for seeking partnerships under the LLC called Nest that I'll be generating as well. And I also want to um, do this because I am starting a family. I'll be getting married hopefully the end of 2024, and I can't wait to build a family with my fiance, my future wife, and I want to purchase my own first house that I can live in, and we can build, we can grow in together. So those are my 2024 goals.
Awesome. Thanks so much for sharing, Jeremy. Yeah, definitely excited that you're going to get married and lots of. And I love how you have all those specific goals, and make sure those are written down and you make them achievable. But one thing with those goals is if you don't name them, if you don't have them, if you don't write them down, you're never going to achieve those goals because you're never gonna start working on them. So again, from yesterday, the first thing is write your goals down. You want to be able to write them down in order to accomplish them. Make sure they're not just in your head.
Thank
Uh,
you. I appreciate that.
does somebody want to share what value did you get on yesterday's session? If you guys are shy, I'm gonna pick on you. Jeremy, since you're on the screen, what value did you get from yesterday's session?
Oh man, yesterday I learned that a lot of it has to do with overcoming limitations, and limitations come from just a lack of knowledge and lack of confidence, and a lot of that can be learned um, by understanding mindset and understanding that each of us have our own specific talents, which is not something that we specifically touched on, but it's something that I kind of was able to reflect on. Is my own specific talents, my own specific gifts are the tools that I need in order to succeed in this industry. So I was able to reflect on my goals and my skills and my talents on, and then actually figure out that it's a mindset over. It's a mindset over no one's gonna carry you and walk you through this process. No one's gonna hold your hand. So that's kind of something that I got out of it.
Awesome. Thank you so much for sharing that.
Thank you.
Angela and John, I'm gonna pick on you guys. What did you guys get out of yesterday's session?
I thought it was really well. The aspect I really liked was the mindset aspect. You got to get over the fear. Like for myself, it's just one of the bases knowing who has funds who can help participate in uh, in a project for in the future. But it's more of looking and saying, okay, find the deal, and the money will be there eventually. It's just the mindset of not living in that fear and analysis paralysis, but just take action.
Yeah. And I think for me, just like retouching on that, you don't have to have everything all perfectly lined up from the very beginning. Like you're going to make mistakes and you push through and you learn through them and you keep taking action and moving forward with your goals. I think that was a really good thing to just have that refresh on there. And then also talking about, having a strategy, having a plan, having a blueprint through your goals so you're not stumbling through that. And I'm excited to learn a little bit more about that part of it. So those are a couple of my big takeaways.
Yeah, no, that's great. Thank you. Thanks for sharing that. All right, so who's ready to get started for today? And let me make sure who I don't know who printed out their workbooks, but if you printed out your workbooks, put it up on screen. Let's take a look. All right. We got color and black and white. Love it. Sure everyone else has the digital version. All right, perfect. So for today, just give me 1 second. Let me just switch the view here. All right. All right. So for today, we're going to take a look at day 2. What's the ideal value add deal look like? And what asset classes are we targeting? So to answer the big question, what are the top 2 recession proof asset classes in commercial real estate? So go into the workbook. Let's go ahead and answer those questions. So we got a bunch of blanks in there. So if you guys are ready, I'm going to go ahead and read this out so you guys can fill it in. So the two most recessionary proof asset classes in commercial real estate, in my opinion, are multifamily and self storage. Because when people live in apartments, they need more space. So again, I'll repeat that. The two most recessionary proof asset classes in commercial real estate are multifamily and self storage. When people live in apartments, they need more space. So, why are these a couple of the safest asset classes to get into? I don't know if anybody has some initial answers for that. And again, part of my journey was, hey, I want to invest in the safest asset class. I want to invest in something that's going to make a lot of money, and I want to be able to have bigger spreads in shorter amount of times and do less deals and make more money. So just to summarize all of that, that's the shortest summary I think I can give. Um, but let's take a look at first in a good market. If we're taking a look at multifamily, some simple things are everybody needs a place to live. So there's always a need for affordable living, which makes apartments a very safe and reliable place to invest. Also, the millennials, we know they're having a harder time affording homes because all of the inflation that's happening. So inflation is happening, the dollar is worth less, and people aren't getting paid to match the rate of inflation. So there's going to be a lot of millennials that just can't afford, unfortunately, to get into their first home, or it's going to be a lot harder to get into their first home. So what's going to happen is they're going to end up renting and living in an apartment for more years until they can achieve um, financial freedom to be able to afford their first home. So again, affordable living is definitely a huge answer when it comes to multifamily and why they're very safe to get into because everybody needs a place to live. For self-storage in a good market, people have a lot of stuff. I don't know about you guys, but who on here on this call like just has a lot of stuff? Some of us are minimalists, but some of us are hoarders. So we have a lot of hoarders in America. So in a good market, people are expanding. They're buying more toys, they're buying more things, and they don't want to always store their stuff in their garage or in their house. So people will get a self-storage unit to go and put all of their beloved possessions or their stuff in that unit. And typically, it just kind of sits there for a long time. But again, with a good market, that's what happens with self storage. I mean, it's a need that people really rely on. Now let's take a look at in a bad market. So things are going south. Why are these two asset classes considered, in my book, two of the top recessionary proof asset classes? So in a bad market, what happens to people that have larger homes or people that can't afford their mortgage anymore? They typically sell their home and they got to downsize. So a lot of times they'll have to end up downsizing and live in an apartment and rent, unfortunately. So also in a bad market, if you own a multifamily unit or an apartment building, there's going to be that need when the economy shifts and goes south. You're going to have more people that need more of that affordable housing that we talked about. Um, Self storage in a bad market. So, horrible economy, what happens? People downsize. When they downsize, they move from a home to an apartment, therefore needing to put their possessions in a place. So, they'll rent a self storage unit, take their stuff, and put it there until they can hop back into a home again. So, this means in a good or bad market, both of these asset classes are safe to invest into. And again, that's why I love self storage. That's why I love multifamily because they're really safe investments and there's always a need for it. Guys wouldn't believe, especially for self storage. I mean, I've looked at properties that are out in the middle of nowhere and they're completely full. And you wouldn't think that anybody lives in those areas, yet there's they're full, and it's just amazing to see that. So going back to the workbook, hope you guys filled that out. Do you guys have any questions regarding that? Just to open it up. Hopefully that makes a little sense. And again, we're going over high overview. There's definitely a lot more benefits. I'm just kind of giving you guys the 30,000 foot view in summary on why I think these are really safe investments to get into.
Hey, Chris, I
Um,
have kind of a dumb question.
yeah.
Somewhat dumb. Also, good to see you.
You too,
So,
Derek.
are we like just gonna, I guess it probably is different for everybody, but in general, should we be thinking of like we're gonna be the ones that are running the business too, or are we just the owner of the building in general? Are you suggesting? And I'm sure it just depends on what we want to do, but I guess that's kind of because this is commercial side's new for me. I've always thought of it more from the residential real estate side. So like it's kind of what you're saying, like we should have a business plan in mind, like to run a self-storage place, or are we gonna just own a building and then have somebody rent it from us and use the space or something along those lines?
Yeah, no, and that's a great question. So the number misconception that a lot of people have with real estate investing, especially commercial real estate investing, is that it's 100% passive. So it's a business, and you have to understand that owning an apartment building, owning a self storage facility, it's still an operational business. Now, if you're a silent partner, you may have partners that are doing all the work, which I've done before, infuse the capital, and my partners essentially are doing the work, and I get the return. Or if you're buying the facility yourself or find your own deal, you can either self-manage it or you can hire a management company and pay them to do all the day-to-day and the management duties. So um, it's I would call real estate more semi-passive than investing than fully passive. Again, there's different ways to skin the cat. But overall, if you go out and you purchase your own building, you are going to have to manage it or hire a management company to facilitate those day-to-day operations. Does that answer your question, Derek?
Yeah, it does. Thanks.
You got it. All right. Anybody else have any other questions? Easy enough. All right. Well, let's keep on moving then. Okay, so we have the two asset classes that I would tell you today. If you're going to start in commercial real estate, these are the two top asset classes that you want to focus on. Now, you can focus on one or the other. Once you know the foundational principles of investing and how to underwrite a deal, you can pretty much underwrite any type of real estate deal. There's different nuances when it comes to underwriting a multifamily deal versus a self storage deal. But if you have the foundation, it's pretty similar. It's not too hard to jump from one to another. I think a lot of people will stick to one asset class and not juggle, in between multiple asset classes. I haven't been a one trick pony, so I've done multiple different types of real estate investing. So I feel like I can jump back and forth, and I currently own self storage facility and I own a multi-family facility right now. So for me, it's pretty easy once you have the foundations down to go one way or another. And some other asset classes too that we can throw on uh, is mobile home parks. So mobile home parks are a great investment too. Again, it's affordable housing, affordable living. If people don't live in apartments, then they go to mobile home parks, and that's where they might live. Or if they travel around, it might be an RV park. It might be, you can still do really well in those asset classes too. But again, if you're going to focus on just a couple, especially starting out, self storage number one, multifamily number two. And the reason I say that is with self storage, you have no toilets, you have essentially no tenants living in there, or you hope that there's no tenants living in the self-storage facility. No sinks, no bathrooms to deal with. You're essentially managing a roll-up garage. So when it comes to managing a self-storage facility over a apartment complex or a multifamily facility, it's easier to manage. You can automate it. There's different ways to automate it. Have a management company take care of it. And also the operational expenses with self storage facilities are much less than multifamily facilities. So you get more for your money when you purchase a self storage facility, in my opinion. But again, both amazing assets to own. Multifamily is a little sexier than self storage, I would say. But again, it's whatever covers your goals, whatever brings in good revenue. All right, so moving on to the next on the workbook. I'm gonna go ahead and read it out. You guys can fill in the blanks. So we look for value add commercial real estate properties. This entails properties that we can acquire and then find multiple ways to add additional revenue. So again, we look for value add commercial.
Hey, Chris, I lost your voice. So I'm not sure if anybody else did. Hey, Chris, I don't mean to cut you off, but I lost your audio. Hey, Chris, I think we lost your audio.
Derek, I like your style. Since we can't hear Chris right now, teach the youth, man.
These guys are on daddy duty, man. I like that.
Awesome, Eric.
Hard to focus though.
I'll be with you guys in a couple of years.
Yeah.
Do you think Chris knows?
I think we should IM him like a different way.
Hold on.
Once-
Hold on. Hey, Siri, call Chris for some.
I tried to call too. Chris? Okay, he's trying to troubleshoot it.
Derek have met.
Chris, we can't hear you.
Let me see.
Hey, Molly.
Hey,
Good to see you.
same here, bro.
Let me try to restart this. Testing.
Nope.
Testing.
Nope.
Yeah,
Wait, say it again, Chris.
testing. Can you hear me?
Yep, coming in.
All right, can everybody hear me? Put a one if you guys can hear me.
Yeah,
Got you.
you're back.
All right. My
You
bad.
left off with us at
Value add.
All
the
right.
last
Thanks, Chris.
you.
All right,
use-
sorry about that, guys. Technology, you gotta love it.
Yeah.
All right, so everyone can hear me. Give me a thumbs up.
Yep. And the last we heard
All right,
you.
did you guys hear what I defined what a value add deal is?
No.
No, the
Yeah.
last we heard you was there.
Okay, I will go ahead and restate that. So again, the question was, what is a value add deal in real estate? So in real estate investing, a value add deal refers to an investment opportunity where an investor can implement strategies to increase the property's value over time. This increase in value can result in higher rental income, improved property appreciation, and ultimately a more profitable investment. Value add strategies typically involve rental rate increases, making physical improvements, operational changes, and increasing occupancy. Give me a thumbs up if you guys all got that. Awesome. So, in real estate, we call this forced appreciation, which you cannot really do in residential real estate. Again, we are force appreciating the price of the value of the property to go higher because we're doing certain things to increase how much profit the property is making. And when you do that, the property all of a sudden is worth more. So remember that forced appreciation. So going to the workbook, we have 4 ways that I'm going to give you guys to add value. And again, there are more than 4 ways to increase value, but I'm just going to give you guys 4 of them for today, just so you guys can start getting an idea of what does it look like and what types of facilities do I need to go search for when looking for a value add property. So the first one, fill in the blank, is rental rate increases. So when looking for a property, you want to find a property that has under market rents. So it could be an owner that has just mismanaged and that has not raised or had any rental increases in maybe 5 years, 10 years. I mean, there's owners of facilities that just um, they don't raise prices, and that shows in their property. So under market rents, you want to make sure. So, for example, if somebody is they have a self storage facility and they're charging $50 per month per door for a certain size, the market rent might be $70 per month, what everybody else is charging. So you come in there, you start increasing prices to what market is, and all of a sudden you've increased the value of the facility by only doing one strategy. So I think that's the first way to look at a facility and say, okay, I think this is a value add property because I see the markets are under rent. And when you talk to an owner or a broker, you ask them, hey, when's the last time the owner of the facility raised rents? And typically you can get a pretty good gauge on, hey, they raised rents last year or 5 years ago, or they haven't had a rate increase in a long time. A lot of times too, and I found this kind of funny, is the property owner, pretty much if it's a smaller facility, they've made friends with all the tenants. It could be in an outside market, a tertiary market, and because they know all the tenants, they feel bad giving them a rate hike, which you should have your facility at market prices. So that's typically something that I have seen also in the past. So number 2 is physical improvements. So we look for properties with light physical improvements needed, whether it's paint, interior finishes, some roof repairs, etc. So if we're talking about self storage, maybe the garage doors need to be painted, or the whole outdoor facility needs to be painted. Maybe some of the shrubbery around the facility needs to be taken care of. Sometimes units are damaged; you have to fix the units. So there's different things with multifamily or apartments. A lot of times, what you'll do with a value add multifamily facility is you have to pretty much go in and remodel each unit. So if it's outdated and you're going to go in and do that for each unit, that's typically a great way to add value in an apartment building is, because that also raises rents after you've done those types of improvements. Again, when you're underwriting your deal, you have to factor that in, and you have to factor, um, hey, how much is it going to cost me per door to remodel that unit, and how does that play in to the whole projection of what this is going to be worth after I put that investment in to upgrade the whole apartment building. Number three is operational efficiencies. So we look for properties with mismanaged operations, whether it's bad marketing, too high of operational expenses, bad customer service, lack of streamlining new technology, etc. So you'll see this when it comes to a smaller facility, smaller property. When I say smaller, I'm talking maybe under 4 million, under $3 million property types. Typically, when they get over the $3 to $4 million price mark, the owners are taking care of those facilities. But on the smaller facilities, you'll see bad marketing. Maybe they don't have a website, they don't have many reviews or any good reviews. When you look at operational expenses, this is huge, because if somebody's paying, typically with operational expenses on a self storage facility, it can be from 25 to 35% of your gross revenue will go into operational expenses if you're managing properly. With multifamily, it could be from 35% all the way up to 50%. So if you go into a facility and you're taking a look at it, and the operational expenses is 50 to 60%, they're probably mismanaging their expenses and spending way too much in areas where they can cut down. So when you take a look at that, you cut down certain fees, certain expenses, you're able to increase the bottom line. And when you increase the bottom line, you're adding value. And when you take that value, that means you have a higher multiple, which is a higher value of what the property is worth. And let's see, number four. Number four is physical occupancy. So when you look at occupancy for a facility, whether it's self storage or whether it's multifamily, a lot of times when you look at a deal, it's going to say, 95% occupied, 90% occupied, 85% occupied, which means that's how much is leased out in the facility. So when looking for value add facilities, you don't really want the facilities that are 99 or 95% occupied. Typically, there's a good formula or a buy box that you would have where, maybe it's 85% occupied, maybe 75% occupied, 60% occupied. And when it's not fully occupied, that's where you dig in and see, okay, why is this property not fully occupied? Again, is it bad marketing? Is the customer service horrible? Nobody's getting back to potential clients. So there's different things you're going to want to look at and dig into with the occupancy. But once you go in there and you get good marketing in there, you raise the occupancy, all of a sudden more revenue comes into the facility, and all of a sudden your facility is worth a lot more money. So that's physical occupancy. Also, there's economic occupancy. So what economic occupancy is how many people are not paying. So if you have a facility that's 85% occupied and it's 65% economically occupied, that means 20% of the people are not paying. So what happens is sometimes landlords just don't kick those people out, especially if it's self-storage. So with new management coming in, you typically will evict those people and come in, empty their stuff, or have them come get their stuff and rent to new paying customers. So that's something that's really important too. It's really important to ask, especially if you're talking to an owner or a broker, hey, what's the physical occupancy and what's the economic occupancy? Do you guys have any questions on those items?
For
This is
yes.
all helpful.
So for that, um,
before you purchase it or even go down that road, do they have to provide you with
All right. No questions?
paperwork on that? I do. Can't hear me.
All right, let's keep moving on.
Molly was talking right now. Can you hear Molly?
So there are multiple ways to find profitable deals. Again, we're in the workbook. You want to fill in find profitable deals. In 2024, find profitable deals. I'm going to have you guys chant that, sing that. Wake up every morning and say, find profitable deals. So there's multiple ways to do that. Going in the workbook, we aim for off-market deals, but we utilize all resources available. Again, we aim for off-market deals, but we utilize all resources available. This is crucial. So some of these different resources include, number one, broker relationships. Commercial brokers go out and find deals. They go out and find listings. They find sellers that want to sell. They're looking for buyers that want to buy. So you want to make sure that you create really good broker relationships. But it's really important. If you go out and talk to brokers, you need to be able to know how to talk to brokers. It's really important. Brokers are pretty straightforward, and if they don't think you know what you're talking about, they're probably not going to give you a call back. So I think it's important to know how to talk to a broker, to know how to position what you want, to know how to explain your criteria, what your buy box is, and give them all that information. And when they have all that information, they know you're credible, they know what you're looking for, you'll be able to hear back from them and they can source you some deals. So brokers are a great way to find deals, but the best way is through relationships with brokers. And real estate as a whole is a relationship game. You're creating relationships with other investors, you're creating relationships with sellers, you're creating relationships with brokers, and you just have to be really good when it comes to being relational. Number two is online platforms. So platforms like LoopNet, like Crexy, there's a lot of different platforms. There's a lot of online platforms where sellers or brokers will go and list their properties. So you can go in and sift through multiple properties. And I think one thing to do for just for homework is to go on one of these websites and start looking for properties, learn what the listings look like, learn what they show as what the return is, what is the pro forma, what are the cap rates. So you want to learn all these definitions, you want to learn all these things. And a good way, again, to do that is go into these online places like LoopNet and just start looking at deals. Number three, direct to seller. So find off market deals by going directly to the seller. I think this is the greatest way and the top way to find a great deal is direct to seller. So there's different ways and different strategies on how to find owner information, how to go, how to talk to them, how to create a relationship with the owner so that when it's time for them to sell, they're going to call you when they want to put their property on the market, or before they market it, they'll call you to see if you want to buy it. I actually had somebody that reached out to me not too long ago, and we were doing some call outs probably about 6 months back, and just calling different owners, seeing if they want to sell. At the time, the guy, he was not interested in selling, but 6 months later, I get an email and say, "Hey, Chris, we're looking to sell now. We're looking to move to a different state. We'd love for you to take a look at the property." And I just thought that was very encouraging when those types of things happen, because you just continue to build up your pipeline, you continue to reach out, continue to create relationships, and it might not happen day one where they're going to say, "Yes, I want to sell my property today," but with consistent follow up, with just being very relational, you want to be memorable. So you want them to you want them to know you as someone that they want to call back. I believe there was a question. Molly, are you there? Did you have a question?
Yeah, I'm here. Thanks for asking. My question
Like it's
was,
not on mute, but we can't hear you. If you want, type your question in the chat.
I think we can all hear Molly except for Chris. Is that correct? Hey Siri, call Chris.
All right. So, any questions in regards to ways of finding a deal? Again, this is high level. Oh, did I lose sound again?
Chris.
Did I lose sound again, Jeremy?
No, Chris, we can all hear you and we can all hear you talking, but you can't hear us talking.
All right. Well, let's just go ahead and if you guys can type your questions in the chat. I'm not sure what's going on with Zoom today. All right, so go ahead and type questions in chat if I can't hear you guys for whatever reason. Zoom is not cooperating today. But we got 15 minutes, so let us keep on moving because I promised you guys something that I wanted to share with you guys, which is what does a great deal look like? So, um, one of the deals that I got into last year was a self storage facility, and I call this one the unicorn deal of 2023. It was an amazing self storage opportunity, and this deal came out of South Florida. So there was an owner that had storm damage. It was an older lady, and after the storm damage, she kicked out everybody out of the facility and just decided to sell this facility pennies on the dollar. So we got in extremely, extremely cheap, $187,000 cheap for 5 acres, 200 units, room for expansion. I mean, lots and lots of opportunity. Again, this facility required a little more heavy lifting, and it tenants at the time, but with the opportunity presented, it was a unicorn of a deal. So I'm just going to show you guys real quick and share my screen, so you can take a look at what this deal looked like. Give me 1 second. All right, can you guys see my screen? Give me a thumbs up. So Storage Town, that is the facility name. So again, taking a look at this, we had about 200 units, about 5 acres, over 27,000 square feet. Lots of open space for parking boats and RVs. Located on one of the main highways leading into the city, and room to add over 270 additional units. Tons of opportunity on this. Now, again, this is not exactly the sexiest property, but the deal is with value add, sometimes you got to add a little makeup on it and make it look good, do a little renovation. But let's keep taking a look at this. So when we decided to create value, here's some of the things that we took a look at. We looked at adding boat and RV storage, making the property look beautiful, adding security cameras, an automatic gate, well lit facility. The website didn't really have a website at the time, so we went ahead and created a website. We added automation where you could rent and pay online. We increased the visibility, um, became more mobile friendly. But just kind of diving into the numbers, So for this facility, again, we bought it for $187,000. We needed roughly, 400,000 or so, 400 to 500,000 to to do the renovation needed, which included new roll-up doors, some gravel for driveways and parking, new AC units, some paint, a new front gate, repair to storm damaged buildings, and some lighting. Also, this would be the future expansion potential, which would be our phase two if we wanted to add some more units. So, with all said and done, if we added that, we'd be at about 500,000 a year of income. And just to show you guys some numbers, one tip is that when you have a property, you can go to a broker and they can give you something called a broker's value of opinion. So once we got into this property, I went ahead and talked to a couple different brokers. They were able to give me the value of opinion of the as is and the value of opinion on, hey, once you guys do all the renovations, you get tenants in, you get this filled up. Here's what the numbers should be, and here's the pro forma value of the facility, which we're currently working on. So let me know if you guys can see this. It says cash flow. Give me a thumbs up. You can see cash flow? No? All right, one second. Let me change the tab. All right, how about now? Thumbs up for cash flow. All right, so here's what a pro forma looks like, just so you guys can just get a little understanding. So this is, again, if we're over here, we're not too vacant, but let's say we're at gross scheduled rent, which is gross rent means everything before you take out expenses. So let's say 332,000. And then I'm just going to kind of quickly go through total expenses. So let's say if we're at 332 and our expenses over here are 91, the bottom line, which is net operating income, which Molly, yesterday you asked, what is net operating income? So to answer your question, net operating income is your bottom line. It's what you earn for the facility after all expenses are paid. So looking at this, 224,000 should be our net operating income. And then this will continue to increase as we increase rents, as we get more people each year. But let's take a look at the 224 just to run some conservative numbers. So one thing you have to do is you have to know how to value a facility and how to run some numbers. Again, I'm not going to go into crazy detail, but I'll go fairly quickly. So if our NOI here is 224, and I'm just going to pull out the calculator of 224,000 per year, and the market value of selling our property, let's say at the time, is a 6% return rate, which is a 6% cap rate. So if you guys don't know what a cap rate is, it's pretty much the return that you get on your investment. So if somebody, for example, buys a property for $1 million cash and they buy at a 6% cap rate, their annual return is going to be $60,000 per year. If that makes sense, give me a thumbs up if that makes sense. Perfect. So what I'm going to do is I'm going to reverse engineer that formula. So I'm going to take the 224,000 and I'm going to say, hey, I want to sell my property at a 6% cap rate. So the way that you do the math is 224,000 divided by 6%. And that takes me to a sales price of $3.7 million. And again, these are conservative numbers. So for this scenario, we purchased the property at $187,000. We put in, at this point, let's say $400,000, which we raised from investors. And that was It was actually 500,000 getting our initial capital back. So all in 500,000. After we're all said and done, our valuation is at 3.7 million. We take out the 500,000, so we're at $3.2 million of profit. And that's with only putting in $187,000 of our own money, which we raised back from investors. So who here thinks that's kind of a unicorn deal? Yeah, definitely an amazing deal. And to add to that, I'm going to show you guys. Well, actually, we'll do this real quick. I'm going to take the 375,000 NOI amount, just so you guys can kind of see the variations and what happens when you play around with the selling cap rate. So again, I can sell for 7% cap rate, which will get me less. I can sell for 5% cap rate, which is not out of the question. And even if I take $224,000 and I'm going to ask a little bit more, I'm going to ask a 5% for a 5% cap rate. I'm listing my property at $4.4 million. So you can see how much the value changes. So when I say value add, I'm saying, hey, if you increase the value and if you sell at a certain cap rate, you can play around with the figures, and there's just huge spreads that you're going to see happen when you move some zeros around. Let's go ahead and let's take, if this property was netting 375,000 a year, and again, this is with the pro forma numbers, but at that point, if we're selling at a 6% market cap rate to the public, we're listing that for $6.2 million. Again, in it for 187,000 originally, selling it after some repairs, $6.2 million. You take back the 500,000. So we pay back the investors. We're left at $5.7 million of profit at that income level. So I think you guys can kind of see, and maybe your minds are blown right now because there's some big numbers. But just to add, I'm going to share the second broker value of opinion. All right, so for this one, he gave me a couple different cap rates. So we're looking at 5.25 selling cap rate. With the numbers that he was pulling, we have a 3.7 million value with an all-in cost of 620, which we're actually below that. If we do the expansion, we'd be at $6.4 million with an all-in cost of 2.2 million. So doing an expansion will take more money to do, but again, you're creating more value and you're able to sell at a much higher price. So, sorry, let me go ahead and come back to the camera. All right, let me know if you guys can see me. Awesome. All right, so with that being said, is this something that you guys can bump up values and create so much more value when it comes to residential real estate? Give me a thumbs up or thumbs down on that. Can you create this type of larger values in residential real estate? No. Jeremy gave me a medium sign. In residential real estate, I think the most value is created if you're actually building the homes yourself. So if you build a home ground up, you can get some pretty good value, but the value that you get off of these commercial deals just are huge, especially again if you're buying right. I told you guys yesterday that you're making your money on the buy. And as you can see with this example, we made our money on the buy. And later we're going to be talking about exit strategies. So that is going to be on day 4. We're going to look at exit strategies. So day 4, I'm going to share with you guys on this property, what are the exit strategies that we have and which one are we going to take? And also, what are the exit strategies that you guys might want to have on a deal that you find? And it's good to know the different exit strategies. With commercial properties, there's multiple you can have, and they could all be win-win scenarios, which I love. All right. Well, I was going to share. I have another multifamily example, but you guys are going to have to catch me offline to get that example of where we did really well. Property out of Boulder, Colorado. It was student housing. We repositioned. We're actually looking to close on that and sell it hopefully this month. So cross your fingers for that one, but also doing really well. And there's just countless examples of ways to make a lot of money in commercial real estate. You don't have to bring money if you have capital partners or if you bring on investors. There's different ways to do that. So don't worry about where's the money going to come from. Worry about how do you find the deal? How do you go out and actually find owners looking to sell properties and take that next step and just really exponentially grow your real estate empire? So my goal is to be able to help you guys do that, to give you guys just a 30,000 foot view. And on end of Thursday and Friday, I'll start talking about if you guys have more interested in working with me one-on-one, what that looks like. I'm looking definitely for people that are looking to take it seriously. So no tire kickers. But I think this is one of the best plays long-term anybody can take when it comes to investing. Learn this stuff, and I don't care who you learn it through. Get involved in commercial real estate, get involved in investing, stop waiting, and just take the leap today. All right. Well, I'm going to go ahead and end this for today. I'm looking forward to seeing you guys tomorrow on the call, and definitely stick with me through the week. Tomorrow, we're going to look at what are different ways to fund a deal and which is the best strategy. So if you guys are worried about how do I fund a deal, how much money do I need to bring to the table, we're going to start looking at that tomorrow, and catch you on the call tomorrow.